John, hi Mary, so nice to see you again. Thank you again for coming to my office. Today we want to go over your financial plan. We did some preparation work in the previous week, and today I have the final executive summary for you. So just to reiterate, the purpose of this financial plan is to provide a framework to help you reach your financial goals and objectives. So the plan consists of several sections, each of which covers the following subject areas: your financial health, risk management, investment planning, retirement planning, tax planning, and estate planning. The plan concludes with an action plan which identifies the actions needed to implement the most essential planning outcomes. Now, a comprehensive review of your financial situation was done with the information you provided to our firm. So the following 4 financial goals were identified and prioritized on the goal-setting worksheet. First, you want to reduce any estate and gift tax liability and ensure all estate planning documents are in order. That seems to be the most important for you. Second, we want to review insurance contracts and discuss the implication of purchasing a long-term care policy. Third, we want to reduce personal income taxes. And last but not least, based on your risk tolerance level, recommend a diversified portfolio that meets your investment needs and expectations. Now, John, remember you completed a risk tolerance questionnaire and you agreed with the results. And you indicated that you are willing to assume an above average level of risk to grow your investments and to achieve your investment goals and protect against inflation. Now, there are some assumptions that we made at retirement. So both of you expect to be in a high marginal tax bracket. The total federal, including and state marginal tax rate is approximately 44%. And you expect inflation to be at around 2.25%, and the risk-free rate will be 1%, and the market risk premium will be around 7%. Interest rates and inflation rates both look to increase in the short-term and long-term forecast. So that's just to refresh our memory before we move on. Do you have any questions for me so far? Very good. Moving along, here are some documents for you. These documents were prepared and are attached to this plan. These are the statement of financial position, ratio analysis, and statement of cash flow. So let me briefly go over them one by one. So the current situation, your current financial situation reports a net worth of $13.77 million and a net disposable income of $107,000 and change. Together, both of you have a sizable net worth and adequate disposable income that can be used to support your financial goals. In addition, we calculated financial ratios that measure your financial status compared to benchmarks. We discovered that you have a high current ratio of 49, which compares your assets to your liabilities and is much higher than a benchmark of 1. You also clearly passed the monthly housing cost ratio of 6.8%, compared with an upper limit benchmark of 28%. So these are really favorable numbers. The monthly housing cost and other housing debt ratios are also clearly passed because 0.5% ratio is significantly lower than the 36% benchmark. So based on the homeowner benchmark of 28% and 36%, these calculations show that your current housing debt load is low and very manageable, and is far less than what your income can support. Also, your current savings and liquid assets, calculating your cash and equivalents, are significantly higher than the 3 to 6 months amount that we typically recommend. Hence, your cash reserve is very healthy. But on the other hand, you may want to consider the amount held in cash deposits and consider other more tax-efficient ways to hold cash equivalents, such as municipal bonds to reduce tax liabilities while maintaining a healthy net return. Your primary home has a fair market value of $900,000 with no remaining mortgage balance. So that's 100% equity. Congratulations on that. And your vacation home has a fair market value of $750,000 with a remaining small mortgage balance of $49,000 with the equity of 93.4%. The mortgage is a fixed 5% rate with a 4.3-year remaining as of December 31st of 2023. Some recommendations I have for you. The installment receivable from the sale of John's business in the amount of $365,678 per year in the next coming 8 years makes up a 54% of your total expected income. Such as a high concentration and these kind of installment receivables may pose risk to your further financial position. In the event that there's a default for some unforeseeable circumstances, such as the buyer passed away or become disabled, as a result, the buyer may be not able to make the installment payment and it will become a major disruption to your finances. It is recommended that John requires the buyer to take out a life and disability insurance policy to protect yourself against these risks. Second, the $800,000 CD is currently under John's sole name. It is recommended that Mary be added as a joint owner to ensure that she can immediately access the cash should anything happens to John, so that there's no liquidity concern and the funds do not have to go through probate to be distributed. And for the purpose as a cash reserve, this portion of the CD should be invested with a maturity of 6 months or less, so in a short-term CD. So going on to talking about risk management. Do you have any questions for me so far? No? Okay, let's move on. So on the risk management side, we reviewed your existing insurance contracts and identified any weaknesses in your insurance coverage. You mentioned that you are interested in getting long-term care policy for both yourself and Mary to manage the rising cost of senior care. We recommend a comprehensive policy that allows each spouse to share the other spouse policy benefits. The benefits will be paid for 3 years or up to $360,000, whichever comes first. The annual premium are $6,400 for John and $5,330 for Mary. Most of the premium is allowed as a medical deduction under your itemized deduction in your income taxes. So buying a long-term care policy will help to manage the rising cost of long-term care, and it also offers some tax benefits and reduce personal income taxes too. So kills 2 birds with 1 stone, huh? So looking at your existing car insurance, looks like it's pretty adequate, but you will need to increase it to cover the new car that John plans to buy soon. In terms of comprehensive risk protection, it is advisable to consider adding umbrella insurance coverage to cover any liabilities, property damage and injuries, so that any accident or liabilities will not negatively impact your financial stability. An umbrella coverage of about $2 million to $3 million is recommended. The homeowner's insurance policy for your primary home needs to be at least 80% of the building value of $775,000 or a coverage of $620,000 to provide you with an adequate coverage should anything happen. So the current policy only provides for $400,000, which is not adequate, so you need to do something to cover the shortfall. So it's recommended that you contact your insurance agent to increase the coverage. Now, for your vacation home, it looks like you have adequate coverage. And as for health coverage, since both John and Mary, both of you have Medicare coverage, and you have Medicare Part A, B, and D, it looks like your medical coverage is adequate. As to the life insurance policies, both John and Mary have specified each other as beneficiaries and have named your children as contingent beneficiaries. This is well done, and the death proceeds from these policies will avoid probate and will be paid directly, free of income taxes, to the named beneficiaries. Now, as I mentioned earlier, the installment receivable from the sale of John's business constitute a majority of your total expected annual income. There is a potential risk there. Should there be a default, unforeseen circumstances, say an untimely death or disability of the buyer, the standard of your retirement lifestyle will be impacted. So it is recommended that in the buy-sell agreement, John requires the buyer to take out a life and disability insurance policy to mitigate this risk. Any question for me so far? No? Very good. So let's move along. Talking about investment planning, we have done an investment policy statement and an analysis on the investment portfolio, and I have attached it to this plan for your review. Let me quickly talk about the current situation. There are 3.84 million in non-qualified assets and 1.599 million in qualified assets. The stock portfolio in the non-qualified portion is not diversified and is underperforming on a total risk-adjusted return basis, as measured by the Sharpe ratio. So as far as recommendation is concerned, to improve the investment position or accomplish one or more of your goals, we suggest that you implement the following. First, diversify the stock portfolio, because there are only 4 stocks with a total cost basis of $968,000 and a fair market value of $940,000. A tax harvesting strategy can be used to create a $20,000 loss in the current tax year, since stock A has an unrealized loss of $218,000 and the remaining stocks all have unrealized gains. Second, since you're in a high tax bracket, we suggest that you sell the bonds and allocate to some tax-free municipal bonds if it creates a higher net yield than the bonds within the portfolio. Third, instead of keeping all $800,000 in a CD, after allowing for 6 months expenses in liquid savings account, the excess portion of the CD can be used to purchase short-term treasury bonds or muni bonds that are more tax efficient. According to the cash flow analysis, keeping around $290,000 in the savings and checkings account combined should be sufficient to cover 6 months' expenses. Allowing for the liquidity need of buying a new car and paying off the credit card debt, around $700,000 can be used to invest in treasury bills or muni bonds. This will be one way to reduce some income taxes from interest received. We recommend building a portfolio of individual stocks and ETFs that are well diversified. It is also important to determine if a growth strategy to minimize current taxes needs to be implemented. If that's not the case, we suggest building a diversified portfolio using ETFs and mutual funds with low turnover and tax efficiency. Finally, we recommend that you continue to invest in securities to combat the anticipated inflation and its impact on your purchasing power over your retirement years. If you accept these investment planning recommendations, we will help develop an asset allocation strategy for your portfolio that maximizes return in a tax-efficient manner, and is more diversified and matches your above-average risk tolerance level. What do you think? Very good. So let's talk about retirement planning. A retirement plan analysis was conducted for John and Mary and is attached in the report that I just gave you. As you mentioned in our previous meeting, you are not concerned about your savings and retirement plan. You have clearly done very well and accumulated sizable assets which are more than adequate to support your desired retirement. Congratulations on a healthy financial position that is meeting your retirement goals. On the other hand, taxes are an area of concern to you. The bulk of the income generated by the investment portfolio will likely be taxed as ordinary income. Since your marginal tax rate is high, reducing taxes if possible is a high priority for you. A review of your investments showed that your stock portfolio is not well diversified and is underperforming the market on a risk-adjusted basis. We suggest change to be made to the portfolio allocation to achieve better diversification and achieve a higher risk-adjusted return. We also suggest that tax loss harvesting be used during the reallocation process to help reduce your tax liability from investment gains. Following along with the strategies on tax efficiency, it is recommended that you add some tax-exempt municipal bonds to your portfolio. We can recommend municipal bonds which are exempt from federal as well as state income taxes to help reduce the overall tax bill you'll be paying on your investment return. For your qualified accounts, since you're interested in ways to grow your 401k and Mary's 403b account tax-free, you may want to consider rolling over these accounts into Roth IRA accounts. You will have to pay taxes in the year of the rollover since these are qualified plans that were funded by your pre-tax income, but you will not owe any taxes on the money and profits on your investments when you withdraw in the future. Please note that for Roth IRAs, there's a 5-year rule that applies, meaning that you need to keep the earnings in the account for at least 5 years before you can withdraw it. To avoid probate, please be sure to name your beneficiary or beneficiaries to your Roth IRA account. If you name your children to be beneficiaries, they will be able to withdraw the money and profits from the Roth IRA after you pass away without having to pay any taxes. Mary may also roll her 403b account into a Roth IRA under similar conditions, since she's over 59.5 years old and can withdraw her account without paying any penalties. The conditions are similar to rolling over a 401k plan. So those sounds like good news to you? Very good. I'm excited for you too. So let's move on and talk about income tax planning. Tax calculations for the down payment and subsequent installments for your sale of business were prepared and are attached to this plan. Reviewing the current situation shows that some changes can be made to reduce your income tax liabilities. Investment interest income is currently taxed at the highest marginal rate. We suggest you purchase some municipal bonds for your portfolio because they are more tax efficient. For the non-qualified accounts, purchase individual growth stock or purchase an ETF or mutual fund that is tax efficient. Number 2, we would recommend that you consider rolling over the investment in the qualified investment account to Roth IRAs to minimize the tax on the future return on investment, which will be taxed as ordinary income when withdrawn if you don't do anything. The recommendation was detailed in the last section. So by structuring the sale of John's business as an installment sale, you have reduced the income tax burden in both year 2023 and over the term of the next 8 years while the notes are being paid. Since long-term capital gain tax rate is lower than the marginal income tax rate and the sale proceeds are spread over the years ahead, instead of a lump sum hitting your 2023 income tax. Since you wish to make gifts to your 3 grandchildren, you may want to take advantage of the front-loading feature of 529 plan to gift 5 years of allowable gift, which is $17,000 per year times 5, which equals to $85,000 to each of your grandchildren without having to pay the annual gift tax. It is also recommended that you maximize your itemized deduction to lower your taxable income. If you opt for a long-term care policy, the bulk of the premium will be deductible as medical deduction under your itemized deduction, up to $5,960 for John and $4,770 for Mary. Lastly, let's talk about estate planning. So a property ownership spreadsheet and estate tax calculation were prepared and it's attached with your report for your review. Let me just quickly talk about the current situation. Neither John nor Mary has an estate that is subject to estate taxes if either one of you were to die this year. However, each estate is subject to probate fees and expenses at this time if either one of you were to pass away. There is a will in place which designates the spouse as the primary beneficiary of each other's estate and the children Edward and Brent as the secondary beneficiary. The will is good in specifying which items you wanted to pass along to your beneficiaries, but unfortunately the will does not help to avoid probate in the state of California. If the title of the property is owned solely by the deceased, it will have to go through the probate process. There are no essential estate planning documents in place as of now, such as powers of attorney, healthcare proxies to manage your affairs in case either one of you were to become incapacitated. There is no trust in place to distribute income to surviving spouse or children or to do charitable gifting. Here are the recommendations for you. First, to change the title of your vacation home, your business buy-sale agreement, your car, your boat and trailer, and the inverted Jenny stem from John's sole ownership to tenancy by the entirety to avoid probate costs. These changes would automatically transfer the properties to the surviving spouse at the first spouse's death, which is compatible with your objectives. Secondly, add Mary as the joint account owner and or your children as the beneficiary to your CD account, to your mutual fund account to avoid these accounts going into probate if something unexpected happens to you. Add Mary and the children as the beneficiaries to John's 401k account. Change the title of Mary's car from Mary's sole ownership to tenancy by the entirety to avoid probate costs. Add John or the children as the beneficiary to Mary's 403b account to avoid probate. Visit with an estate planning attorney to obtain power of attorney, healthcare proxies, and to discuss different types of trust instruments, such as living trust, testamentary trust, qualified terminable interest trust, QTIP or QTIP, and power of appointment trust to accomplish your estate planning and gift-giving goals and reduce tax liabilities. Implementation. This is important. An appointment with an estate planning attorney is needed to accomplish these estate planning objectives and should be made as soon as possible. The costs for implementing these recommendations include changing property titles and attorney fees. The cost to implement is approximately $10,000, and this expense can be disbursed from cash that is currently held in your joint checking or savings account. Finally, the action plans. I notice a lot of financial strength in your finances and during doing the financial analysis, which is really great. However, our analysis also showed that there are 5 specific areas that need attention. These recommendations are aligned with your goals and will help achieve your objectives. Firstly, you want to visit with an estate planning attorney as soon as possible to obtain proper estate planning documents and possibly set up trusts, to plan for either spouse incapacity and to ensure all estate planning documents are in order. This is the first goal you identify that require immediate attention. An attorney can assist you with implementing all the estate planning that is recommended in this plan, including setting up trusts and transferring property titles to the trust. Would it be possible to set up an appointment with an estate attorney this week? Second, you want to purchase long-term care coverage. That's something that our firm can help you with if you need help. And reviewing your insurance, you need to talk to your current insurance agent to upgrade your home insurance policy on your primary home to add additional coverage to cover up to $622,000, which is 80% of the building value of your primary home. Also, consider purchasing umbrella insurance of $2 to $3 million to cover any liabilities to properties and injuries. Thirdly, you want to meet with the buyer of John's business and ask them to purchase life insurance and disability insurance to cover the risks on the outstanding balance on the installment sale. Number 4, you want to discuss with your CPA to maximize your itemized deduction on your income tax return. If you decide to take advantage of the 5-year front-loading feature of the 529 education plan to gift to your grandchildren, you also want to inform your CPA. Lastly, you want to diversify your stock portfolio and reallocate your bond portfolio. Our firm can help develop an investment asset allocation strategy that maximizes investment returns, minimize taxes, and is aligned with your risk tolerance. We will present our investment planning recommendation to you at our next meeting. How about we meet again in 2 weeks' time?